Looking for extra income to pay the bills? Or maybe you're just looking for some money to build a freedom fund and leave your 9 to 5 because you just need a timeout in life. You need some more peace. Or for others, you just need an adventure to get out of your comfort zone, but you don't want to deplete your whole savings account and come home broke. So, I might just have the answer for you. Today's video, I'll be looking at 5 dividend ETFs to help generate close to $1,000 a month in passive income. And I'll be looking at 5 ETFs that have exposure to the S&P 500, namely JEPI GPIX, a fan favorite SPYI, an emerging fund TSPY, and a slightly unknown fund called XPAY. So in today's video, I'll start off with talking about some key specs of each of these funds, and then I'll talk about how to use some approaches or strategies to generate $1,000 a month. Okay, so let's start off with what are some key specs. All right, if we look at the total return over the last couple of months, interestingly, you can see that JEPI, which is from JP Morgan, is in the leadership spot. I mean, to me, that's a big surprise because, at one point, a lot of people were saying JEPI was the best fund. And then last year, people were jumping ship to funds like SPYI, saying that JEPI is not in anymore. But if we look at this chart, JEPI is doing pretty good. And it might say a lot about how this fund performs in sort of a more uncertain, volatile market like we're having this year. Okay, so if we look at this in closer details, you can see that in the 1 month return, JEPI is in the lead, 6 month return, same thing, and even the year to date. Now, if we look at the 1 year return, you can see that JEPI is at the bottom, and surprisingly, XPAY or XPAY from Roundhill Investments is leading the pack with 16.15% in total return. And we'll talk a little bit about this later in the video. Okay, so let's briefly talk about JEPI. Now you can see that published the distribution rate is about 7%, but the 12-month rolling is close to 8%. And that just means that they're taking the average of the last 12 months. And then that's the actual dividend or distribution it has paid, which is probably a better indicator of how the fund is performing and executing. Now, if you look at some more details, especially related to objectives, and you'll see a lot of the same thing in the funds that I'm about to cover. They sell a combination, or they do a combination of selling options. They own maybe some of the stock, so they get stock dividends as well. And the idea is to have a little bit less volatility, still keep up slightly with the benchmark, which is S&P 500, but with less volatility. So if we look at some of the holdings, a lot of household names, we see Google, we see Amazon, we even see Nvidia. Now, what I like about JEPI that's a little bit different than other popular ETFs is the weighting is not so much in any one holding. So if one fund or two funds, especially like the Mag 7, aren't doing well, it's not exactly going to pull down the fund, at least like it does in other funds. Now, if we look at the performance since inception, I mean, if you had $10,000 in this fund in 2020, you'd have close to $19,000 today, which is about a 90% return. I mean, to me, that's incredible. If you're talking about distributions and capital appreciation, that is beating a lot of other funds in the market. Now, if we look at the calendar year performance over the last 5 years, you can see that F1 is the NAV and B1 is actually the benchmark, which is the S&P 500. And in most years, if you held the S&P 500, you would have outperformed. But let's take a look at 2022. According to the NAV, it didn't take as much a hit as it did the benchmark or the S&P 500. So I think funds like JEPI probably do belong in a portfolio because they do kind of help against volatile markets like we're having in 2026. Okay, so let's move on to Goldman Sachs S&P 500 Premium Income ETF, which is GPIX. Again, it's about 8%, so it's kind of similar to JEPI. And if we look at the objective, same thing, 6 monthly distributions. By the way, all these ETFs pay monthly. Broad market equity exposure with low volatility, similar to JEPI. And again, it's a way to diversify your income. So it's not meant to be the main source of income, just a supplement. But we look at the top 10 holdings. Again, a lot of Mag 7 names here. But where this is different to JEPI is some holdings are quite big and it's trying to mimic the S&P 500. So it's not exactly equal weighting. So sometimes this can be good, but then sometimes it could be bad. I mean, let's say NVIDIA just is not doing well, then it probably bring down the whole fund, and then the options may be harder to execute. Now, when we look at the growth, it's still pretty good. I mean, if you had $10,000 at inception, which was about a few years ago, you'd have about $16,000 right now. So that's a pretty good return. And if we look at the annualized returns, again, most of these ETFs are not going to outperform the S&P 500 in the long run. Now, if we look at the SPYI, which is a really popular fund these days, and there's a lot of good reasons why, I'll talk about that in a few moments, but you can see that the published distribution rate is about 12%, and the objectives quite similar. But the big difference between SPYI and maybe JEPI and a GPIX is it has some different ways to approach tax. So at the end of the year, the way that it looks at distributions or income might actually be favor people who hold SPYI because you can use some different tax strategies, namely Section 1256 contracts. Okay, so but again, this is a monthly income fund, holds a lot of these same S&P 500 Max 7 names. You can see NVIDIA's at the top. So SPY does have a little bit of volatility because it does have not an equal weighting, and it does options a little bit different than the other funds. But if we look at the growth since inception, you can see that if you had $10,000 in this just a few years ago, you'd have upwards of $16,000. So that's pretty good performance. You don't see as much NAV decay in SPYI as you do other ETFs, and the dividend may not be the biggest, but I think it's enough for people who are sort of close to retirement or in retirement and looking just for a financial freedom fund. Now, if we look at the month-to-end performance, you can see that in the year, again, S&P 500 is outperforming, but SPY is not too far behind. And if we look at the inception, again, it's underperforming the S&P 500 benchmark, but you're not trying to outperform with this fund. You're just trying to keep stable NAV and receive a high income every month. Okay, let's move on to TSPY. Slightly newer fund, but I think gaining popularity. I really like their website, much easier to navigate than other ETF websites. Again, if you look at the distribution rate, a lot higher than JEPI, SPYI, and GPIX at about 14.64%. Now, they have a different way to approach options. They do zero DTE options. So if you're looking for kind of diversity and how an ETF does option plays, TSPY might be a good addition. Okay, so a little bit different. It doesn't try to mimic the S&P 500 exactly. It just holds shares of SP, and then it runs options on some of those. It does have a little bit of cash, and then also some funds like First American Government Obligation Funds and some other stuff. I couldn't include everything in the screenshot, but you get the gist of what's in this fund. Now, if we look at the performance, you can see that as of March 4th, which was last week, you can see that it's doing okay, sort of middle of the pack, not as great as, let's say, an SPYI. But if we look at the price performance, 26% over the last couple of years, I think that's great. Okay, our last fund for this video will be XPAY, SP 500 Target 20. And the reason why it's a Target 20 is because it's trying to distribute at least 20% annually. And some of the objectives, same thing, monthly distributions, may have some strategies to be tax efficient, and there's some total return potential. It might be a little bit hard to see that in a year like 2026, but in a full-on bull market, then you'll probably see where these kind of funds shine. Okay, so it doesn't actually hold funds or anything in the SP 500. It just holds options on SPY. And you can see that there is some pretty good fund performance. It's not doing the 20% return, or it is, but the fund isn't keeping up with its NAV. I mean, if we look at 1 year, 60% is still pretty good. It's not 20%, but it's 16%. NAV is relatively stable. And since inception, it's about 15%. So you're not losing money with this fund. And to me personally, I really like this fund. Now, I'll tell you some reasons why XPAY could be in a fund in just a few moments. But let's talk about how to generate $1,000 a month in passive income. Okay, before we move on, just a reminder, this video is for entertainment purposes only. It is not intended as financial advice. Please consult with a qualified financial advisor before making any investment decisions. Okay, so the big news of the hour, how to make $1,000 in income. Now, if you hold JEPI only at 34 cents per share, you need at least 2,900 shares. And for SPY at 52 cents per share, you'll need at least 1,923 shares to generate $1,000. And if we look at that in a dollar figure for JEPI, because the distribution dividend rate is a little bit lower, you'll need more shares, meaning you'll need more money at around $174,000. SPYI's distribution is much higher than JEPI, so you only need $100,000. Now, I didn't put GPIX here because it's sort of similar to JEPI. You'll need a lot of money to actually generate $1,000. So think of JEPI and GPIX as kind of the same or similar. Now, if you look at the last two funds, TSPY and XPAY at 30 cents per share, you'll need about 3,300 shares, and XPAY at 90 cents per share. You'll need 1,112 shares, or 84,000 for TSPY and 58,000 for XPAY. So XPay is actually the most risky of these funds. That's why it generates a higher distribution. But on the upside, you don't need as much capital to start with in order to generate $1,000 per month. But I know some of you might be thinking, gosh, I don't want to put all my eggs in one basket. Maybe I want to diversify a little bit. So here are some income approaches for diversifying some funds. You have the core satellite approach, you have the risk parity approach, and you have the barbell approach. And in some ways, all of these have overlapping strategies. So today, I'll just go with the barbell approach because I think it's kind of the easiest one. But the core satellite and risk parity are also great approaches. You might see Eugene Vasquez videos, and sometimes he talks about the core satellite approach. But let's move on to what the barbell strategy is. Okay, so with the barbell strategy, you'll choose two funds, and one fund will have a no or low risk factor. I think it's kind of impossible to have no risk in the market, so I just put low risk, but the original strategy says no risk. And this is your anchor. So this is probably the bigger part of your two fund portfolio. And then the second fund will be the high risk, and this is known as the booster. Slightly more income, but a little bit more risky. So it's a smaller portion of your portfolio potentially. Now, if we look at barbell strategy one, I would say that JEPI is a lower risk fund than, let's say, an XPay fund. And this is using a 50-50, so 50% in JEPI and 50% in XPay. So JEPI will have 1,450 shares, XPay will have 556 shares, or 87,000 in JEPI and 29,000 in XPay. And if you have these two funds together, you can generate close to $1,000 per month. Now, the good thing about this strategy is it lowers the capital needed. I mean, if you only had a JEPI, you would need 174,000. But having a little bit in JEPI and a little bit in XPay, you don't need 174,000. You can still generate the $1,000 per month, but you have a little bit more balanced risk and a little bit of tax hedging. Now for barbell strategy two, I chose SPYI, and it's not exactly low risk. I'll say that it's sort of close to the mid-range risk, and that's one of the things to talk about with the barbell strategy. It doesn't look for mid-risk funds. It looks for one low risk or no risk and one high risk fund, and they think this approach will outperform. Now, SPY again, a little bit higher than low risk, but with 962 shares, and XPay again high risk part of the portfolio at 556 shares, you need only $79,000 to generate $1,000 per month. And this lowers the capital needed. You reduce some risk. And again, there's some advanced tax strategies. Okay, so this is an alternative strategy, not really a barbell strategy because this is sort of the middle of the pack. We're going for SPYI, which is a middle range risk, and TSPY, which I think is still high risk, but a lot of people will say that it's mid risk. Now, if we look at the share count, you can see that 962 shares for SPYI and close to 1,700 shares for TSPY, or about $92,000. So a little bit lower or higher than the last one. But I think probably people have a little bit more confidence in SPYI and TSPY than they do in funds like XPAY. Now, this is good because it has a diversified option timing. I mean, you have laddered options plays covered with zero GT option plays. So this might be a good combination for some people. There is some reduced risk because you have income in or money in both holdings. And then there are some tax efficiency approaches for these funds. And so just to recap with the 50-50 approach, you need $116,000 for JEPI XPay, $79,000 for XPay and SPYI, and 92,000 for SPYI and TSPY. Now, for those of you who still might not have that capital, you can go with the 40-60 approach. And this means that you have 40% in low risk and 60% in high risk. So for JEPI and XPAY, originally you need $116,000, but you go down to $107,000. For SPYI, you go from 79,000 to 75,000, and for SPYI and TSPY, you'd go from 92,000 to 90,000. So the biggest winner for this 40-60 approach is probably the first combo, because you're saving close to $9,000 in this approach. But I know some of you might be thinking, gosh, I still don't have that much money. Where do I start? Well, there is an approach called the accelerated snowball, and that's how I actually started. So you'd have the 50-50 combo, but you'd only start with half the capital. I know for some of you, $40,000 is still a lot of money. Trust me, I know, because I had to start from less than this. But it's just a place to think about in terms of where you are and where you could start and some ways that money can compound. Now, if we start with half the capital with SPYI and XPay and we drip plus we add $250, you'd be able to make $1,000 in income passively in 3 years. If you only dripped and you didn't have the additional $250 of fresh money, it would take 4 to 5 years to actually build this portfolio. Now, for those of you who do geo arbitrage, meaning that you move to a cheaper city that has more affordable living costs, you could actually do this in probably 2 to 3 years, or even 1 year if you're moving to like a place in Southeast Asia and you can work an online job or something like that. Okay, for SPY and TSPY, a little bit more, you need about $46,000 or 3.5 years. Now, here's some higher risk options. And again, these are really high risk options, so make sure you know what you're doing. Now, and I think in a raging bull market, I mean a really good green market, then you might attempt something like a 30-70 or even 20-80 blend. But again, I wouldn't do this in a 2026 market like this year because you never know where the market is going to go. And if you're putting too much money in the risk part of the portfolio, you could really hurt your portfolio. Now, for margin enhanced portfolios, I would say don't buy high risk. So if you're going to use margin, maybe put more of that margin in a low risk fund like JEPI than XPay or SPYI. Okay, because if the market turns red, your market's going to get wrecked really fast with margin. Now, I don't know too much about HELOC loans, but I know a lot of people do it online. Again, I think you would do this if you're relatively debt free, meaning you don't owe any other debt. And if you did take a little bit of loss, you could recover. But these are just some higher risk options to enhance the accelerated snowball way. Okay, so just finishing off the video, here's a recap. I talked briefly about the barbell approach and the accelerated snowball. And these are some strategies on how you can diversify your portfolio and build up to a $1,000 per month passively income portfolio. Now, for those of you who are looking for more creative ways to build income, you could pair that with geographical arbitrage. And for those of you who've been in the market for some time, there are some enhanced risk options. Again, be very careful with these enhanced risk options because they can really wreck your portfolio. But using a combination of all these four can help you make at least or close to $1,000 per month with some of the funds that I talked about today. Okay, so that's 5 dividend ETFs for $1,000 a month in passive income. Hope you got some value in this video. Please like this video and subscribe to watch more free content on achieving financial freedom and living in Asia. And you might like these videos as well. Thanks very much for watching the video. Take care and see you in the next video. Peace.